Hello, ladies and gentlemen. Welcome back to part two. And I wanted to talk to you about imbalance versus balance as I had suggested. But actually, what I'm doing all the time is I'm obviously reviewing what I'm putting out and giving as information in terms of the last section. And as I said, it's very true. It's all unscripted. I don't need to do any research. I know this business back to front because it's what I've been doing every day for most of my life. So um, everything I need to know, it's there. It's just trying to figure out how to get it out. So I don't necessarily do any research. And I found the best way for me to do that, as I've said, is yeah, I can put a few of these tables together and things that you see sometimes, but really it's just coming out. I don't know exactly how or in what order or exactly what's going to happen. So that's why I like to go and review what I'm doing just to make sure, have I missed anything? Is there anything that I could have um, explained a little bit more fuller? And what I realized is when I was reviewing the last piece of information, Auction Market Theory Part 1, towards the end, I realized, and I'm really glad I did it, that I discussed this notion of the supply side being more dominant in more common goods and services that we are used to participating in. So don't forget, every good or service that you buy is a marketplace. In the same way that obviously you see this market in front of you. And I touched upon it before where I talked about market structure. I think that was in the possibly the reality video. I can't remember exactly, but I talked about it in one of the previous videos that people talk about market structure and they're talking about financial model, but actually what they don't realize is every single good and service in the world is a market. But anyway, so coming on to the point, so I was talking about this notion of supply being the dominant factor. There's this thing I've wanted to introduce at some point in the course that was a major turning point in my career. Um, and I know I talked about this in reality check, and you might be thinking, well, hang on, didn't you say in the reality check there was certain turning the key turning points in your career? And this is very much related to that, where I talked about giving the market wiggle room. And so I realized, this is a perfect opportunity for me to seize on the fact I mentioned about supply dominance and obviously the webcam market, bread market, so on and so forth, and to really show you why that is the case. And um, I'm going to say this now, but um, I'm obviously going to prove it as well to you. And that is, there's a reason why the failure rate in this business, and forget about retailers using retail indicators. I don't even include those in this failure rate because that's zero. They're not even part of this data set or worth even including in the data set because they've failed before they've started. I'm talking about not only professional traders. Do you remember I talked about in the reality check video, I said that it's just people using even professional tools. So even guys I saw coming into the institution every, um, you know, um, sort of recruitment round where we'd have new graduates, new people coming in, not only graduates, but obviously people who had come from different professions or whatever and decided they wanted to give a crack at trading. And we used to get people who would obviously come in through the door and obviously in the institution we'd put them through the program, or the firm that I worked for would put them through training and etc etc. But so they'd be teaching them all these tools that I'm going to teach you, and yet the failure rate was still very high. As I said, 80%, 90%. Um, and it started to dawn on me why that was. It's because I've realized over the period of my career, very few people in the market, or sorry, in the world, actually understand what the market is. They just don't understand it. Even these guys coming through professional firms, and I realized that's why, even when they were given the tools, as I'm going to give you, very few people make it because they don't actually understand what the market is. Um, so they don't even understand what they're getting themselves into. It's like if you're going to go into business and you don't understand the market, you failed before you started. And um, what I want to really show you is what the market actually is, because if you don't understand what the market is, then obviously you're in trouble. The positive side of this is, um, at the end of this, if you can accept this and not only accept what I'm telling you, but through evidence, see what the marketplace is, you're going to be up there with very few people in the world who actually understand this. Now, that's a bold statement, so don't just take my word for it. Let me show you why that is, and then you can decide whether you agree with me. And I think you will agree with me, that you're going to be in a very small company of people that actually understand it. Because when you see what I show you and you actually compare it to all the garbage you've been told, not only on social media, in books, on the news, everywhere about markets, it's going to shock you how few people actually know what a market is, as in a financial market. So what I'm going to do is I'm just going to crack on and get into it, and then we can come back to that point, because I don't like to make bold statements without backing them up. So it all really started in my career, and don't worry, I'm not going to give you a whole life story, but there was a point in my career when obviously I was working in big institutions, as you know. So I was bound to come across some incredible people. And actually, and I'm gonna give you like a couple of books that I recommend that you do read. I'm very anti books because they are all garbage. Um, but when you go into a professional trading firm, there's a couple of books that are essential, compulsory reading. They will ask you to read them before you start on the training program. And don't forget, my whole job here is to replicate a professional firm trading program. So it's important I tell you what it's like. So if you want to really um, align yourself with a professional approach, then it's probably good to read the books that they're recommending them to read. So one is Market Wizards, and then there's some books on market profile as well, which I'll tell you about later when we get into profile. So highly recommended read, Market Wizards, great book. Basically, it's this guy, Jack Schwager. You may probably have read it or may not have, but um, what it is, this guy, he goes around interviewing the most successful traders in the whole world and asks them asks them a series of questions, and then he makes a book out of it, where he interviews these guys. And these are like obviously the most highly making tens of millions, if not hundreds of millions, if not billions. And actually, there was a guy that I used to work close to, and he was in the book. And however, the problem was I found it very difficult to. I I used to really not like the guy very much. I'll be honest with you, because every time I tried to ask him anything, um, I, he never had, and I don't know whether it was intentional or what, or he just never had time for me. I don't know if it's because I was a junior and obviously he was this guy doing well and looked up to, and well known. I'm not going to say any names, but obviously well known and obviously incredibly successful. Um, but the only reason I'm telling you this is because he's in this book, Market Wizards. And so I'm thinking, wow, I need to extract as much information as I can out of him. But I'll be honest with you, I ended up getting virtually nothing. So, it was a bit counteractive, to be honest. But there was something, and I'm coming to the point, and it's to do with this, what I've written here, price 50/50. So one of the very few moments where he did actually give me a few minutes of his time. So he would say things like, when I try and ask him about the market and what his view was, and why did he think that the market was going to go up, he'd say things to me like, um, well, I thought that there would be more buyers than sellers. And then if it was going down, he'd say more sellers than buyers. Do you see what I mean? It's like, I think it was, I just felt like he was winding me up. However, there's one thing he said to me that really stuck in my mind. And he said to me, you're never going to succeed in this business unless you realize that at individual price points, the chances of the market moving are 50/50, right? And honestly, I just couldn't get this out of my head for the early. I mean, I was very fortunate. Obviously, I did okay using depth of market and techniques, obviously volume analysis on the depth of market. But so I was lucky. It was enough to keep me in the game, keep me profitable enough to sustain and keep me having a full-time career out of it. But I really never got, that, like I talked about earlier in my career in the reality check, as you see with some of my stats I put out, and I really never got to that stage where it just started to get exponential. The trading was until I actually understood what this actually meant. That at every single point in the market, there's only a 50-50 chance of the market moving up and down. So, and I think this is the problem of most people that approach the market. Would you agree that when people open up their chart, they look at where the market is and they think, oh, it's cheap, oh, it's expensive? You've got to understand that at individual price points, the market is not cheap and it isn't expensive. It's 50-50 at every single. I cannot say this to you enough. And look, don't worry, you're not going to get this immediately. You might have to go and watch this a few times, but I can promise you it's going to increase your chances of success by like 1,000,000% if you can understand this concept of every single time you're watching your chart and you're watching price move up and down, the opportunities are 50-50. And it's so difficult for people to grasp this concept. Because what are people always talking about? They're saying, oh, the market's cheap, buy it. This Fibonacci level, 50% retracement, so the market's cheap. I cannot tell you how ridiculous that thinking is and how far away from the truth you wouldn't even believe the way that you've probably been thinking about the market is. And you just have to recognize what the market is. That at every single price point, the market, every single opportunity or profit opportunity is already priced in. There is no more than a 50% chance of the market moving up and down at every price point. So anyway, I'm telling you this, and there's a lot of stuff that I've told you that without getting you on the depth of market or allowing you or giving you some evidence, that it would be very difficult for you to understand that. And this concept is obviously one of those where without me actually showing you, you won't believe it, because it's so ingrained in your psyche, your psychology, or your DNA, not necessarily DNA, but it's ingrained within your sort of understanding, observation, skill set that you've built up over years, because everything you've been told about markets is this notion of things being cheap and expensive at price points. So unfortunately, I'm going to have to break that all apart. But believe me, it's good for you, because it's going to help you to stop approaching the market for the rest of your life in the wrong way and start approaching in the right way. But before we get into that, so let me explain to you why at every price point is 50-50. And it comes back to this thing I was talking about. You might think, oh, I've gone off topic, but I haven't. As I said before, everything I say to you, yeah, you might think I'm waffling on, and probably some of it is, me just having some musings, but 99% of what I'm going on and on and on about, I'm telling you because it's actually relevant, although you may not see it right now. So anyway, so this supply being dominant factor, it comes back to this point. So what I've done is I've split up things in terms of factors, and then I'm going to compare them to, I've put here financial assets, but actually it's, I'm going to put here spec, because this relates more to speculative markets that have a liquid marketplace. So that's anything, FX, commodities, equities. Because someone could, in theory, and they'd be right to argue with me and say, hang on, a savings account is a financial asset. Yeah, it is, but obviously it's not a traded, at least not in a liquid marketplace. You'd be surprised at things that obviously banks do structure products up, things like savings accounts, and they do trade them. But the point is, in terms of a liquid marketplace I'm talking about, when I say financial assets, I'm going to compare it to non-financial assets. So obviously here, these are going to be, I'm not going to spell it out, but bread, milk, webcams, chocolates, property, and so on and so forth. So what it is these are essentially, don't think, I mean, I probably could have been better with my headings, or I put financial asset, non-financial asset. What it is I'm just trying to differentiate between financial markets, liquid marketplace that you see on your screen as a speculative market, and more of these traditional everyday markets that you participate in as part of your daily life. So things like, buying bread, buying milk, buying a webcam, buying, obviously there's a mouse here, buying coffee cups, buying, what have I got here in my room? Books. I've got a jacket here, I've got a mobile phone, I've got a radiator, I've got, the list goes on, but you get my point. Fridges, whatever. What you have to understand, and I've said this before, is there is no difference between you buying pound dollar and you buying a fridge, and you buying a coffee cup, and you buying a speaker, and you buying a computer, and you buying a keyboard. It is an asset, it has value, and you can, in theory, sell it. Okay? You have to understand this. There is absolutely no difference. And therefore, to a large extent, the marketplaces, they function identically. As I showed you in the last part 1, auction market theory, that was the whole point of auction market theory part 1, so you can understand there's very little difference theoretically between these marketplaces. However, in practice, when we actually get down to it, of course there's differences in the way they function, in the sense of structurally. So this is where you really have to understand and take your understanding of this concept that I described before to the next level. And look, you don't really need to believe me or take my word for it. I've already showed you on a depth of market, and just go out in the marketplace, and I even showed you before. Well, what do you think Amazon are doing? They're on the offer side of a depth of market on every single product on their website. What do you think Tesco are doing? They're sitting on the offer side of the bread market, right? And what are you doing? You're placing market orders when you go into Tesco. It's exactly the same. Someone out there is offering you pounds. What are you doing? You're buying them. Obviously, there's the added complication here of it being a two-way market, and that's, these small factors is the whole point of this, where we're now going to take a deeper dive and actually look at more specifics of this concept of, and it's not even concept, it's the reality of how markets in general are slightly different in terms of, obviously, speculative financial markets. So let's go through the list so we can actually come back to this point about price being 50-50 at every price point. So that's going to be the easiest way if I take you through these things and we kind of go together and look at the differences between these traditional markets and obviously speculative markets, which at its core is the same. So supply is dominant. Now, I talked about this before, but we're going to talk about it again with the webcam. So I'm using webcams because I don't want to just stick to the same examples. I want to show you it doesn't matter. Milk, bread, webcams is so random. Let's talk about webcams so I can show you it applies to everything. So we said, and sorry, I've put this in the bid column, haven't I? Get this in the price column. So we said £100, typically could be the webcam price, but let me put a few prices here. 103, 104. So you see these columns. And again, as I said before, let's not worry about bids, the bid side of the column. Let's just concentrate here. It doesn't matter. We're talking about supply and demand, right? Supply, demand, okay? Let's not complicate it by using all 4 columns just to obviously prove the point, because it doesn't matter whether we use 4 or 2. Would you agree that, and again, I know I talked about this before, what is Amazon actually doing, or Tesco bread, or whatever, supermarket, milk, or your corner shop, or whoever, what are they actually doing when they participate in the marketplace and put things on their website? Can you see all they're doing is they've bought, so they might have bought at £100. What are they doing immediately? I don't know, let's say they got 10,000 units. Can you see what they're doing? They're buying at 100 and they're offering it out immediately at 105. Would you agree? Yeah. So do you remember the banana market example? Now, look, I did this so long ago, um, and my memories unfortunately deserted me slightly, but um, I can't remember if it was $11. Forgive me if it was 10, but let's just say it was $11. Someone in the banana market, you bought it at 11. What did they do? They offered it out at 12 to try and take the tick or whatever it was. What do you think Amazon are doing? They're doing exactly the same thing. They're buying webcams from Logitech or whoever the manufacturer is at 100, and what are they doing? They're offering it out at 105, right? But what you've got to understand is that they are essentially the entire supply column. I understand there's other people offering cameras, but generally in everyday goods and services, it's incredibly inefficient, okay? The way that these markets work, and that presents profit opportunities. Because what happens is pockets of inventory are distorted. They're sitting in warehouses at individual companies, aren't they? Do you see this issue doesn't exist in the financial marketplace? Why is that? Because you've got an exchange, you've got a depth of market. You can see everyone who wants to sell can quite easily come on a platform. Structurally, it's very different. So you have to understand this concept of why inefficiencies that exist in everyday goods and services simply don't exist in a financial marketplace. So we'll come back to that point. Let's again really hammer this point home about supply being dominant. So let's prove it to ourselves. So you now agree with me, Amazon is on the webcam depth of market, right? So let's get rid of crude oil and put webcam here. So they've offered out 105. How can this price move to 106? And I'm going to skip a few prices and put 110. What can cause this price to go from £105 for a webcam to 106? You know this, as I said before, it was a rhetorical question. Market orders can come in, but can you see it doesn't work like that in the webcam market? Because if Amazon really wanted to, do you agree? They could decide, do you know what? We got 10,000 units in our warehouse, which we're offering out. We don't want to offer those at 105 anymore. We decided now to offer those 10,000 units at 110. What's just happened to the price? Right, it's moved up to 110. Now, this is obviously an extreme example, but because normally, obviously, some people would be buying at 105. But in theory, can you see? Not a single market order took place there, yet the price still moved to 110. Why is that? Supply. Sorry, I scribbled that. But supply is the dominant factor. Suppliers are setting the price. Don't get me wrong, I'm not saying that demand doesn't matter. Of course it does. And in some markets, demand is going to be, 50-50. It depends on the marketplace and how concentrated inventory is amongst big players. Obviously, in cartels, as you know, oil cartels, you've heard of these things, where collusion takes place, where there's very few players. The more of that going on, obviously, the more price can be manipulated and set by people who are supplying. But you've got to understand that on the depth of market, in the majority of goods and services, suppliers are dominant, which creates profit opportunities. So it's moved up from 100 to 110, and obviously, as I said, it's the supply side. Now, so hopefully you agree with me then, supply is dominant, but how is that different here in the speculative market? So this is why I hope you can understand I had you on the depth of market for so long, because if I hadn't, honestly, you'd be completely lost if I was trying to explain this to you without you being on a depth of market. So we just said the price can jump from 105, right, to 110 because the supplier just decided what? Well, that's where they're going to set the price. Now, again, I'm going to repeat the point. Don't misunderstand me. I did say in the last section, and it's true, of course, Amazon, Tesco, whoever it is, are going to be looking at market orders and deciding whether it actually makes logical sense to do that. Of course they are. So I'm not saying supply is the only issue, the only factor. Of course demand matters. But my point is, in a normal financial market that you see on your screen, can you see what's actually happening? Let's say £100 Logitech was actually traded on a financial market. What you'd actually find is, firstly, and I talk about it here, prices. So it brings me on to my next point. Would you agree? The increments in financial markets are very, very tiny. So literally, what you'd have is the price would be going from £100. Sorry, let me just give me a chance to draw these in. 5, 6. Guys, we just talked about the price moving up £5. You'd be lucky if this traded in a financial marketplace for webcams to go up 1p in the way that Amazon decided. Because what Amazon will find is, so let's say, and in fact, I'm sorry, what I'm going to do is, I'm sorry about this, let's, just to make it exactly equal, because I did say the price moved from £105, let's actually make this 105. So £100 is there. Let's have £100 and then 105. But obviously before we were jumping from 105 upwards, right, to 110. Let's say it's 105.01, just so I can make it equivalent to what I was showing you before. 105.02, 105.03, 04, 05, 06, 07, and so on and so forth. Right, so can you see what's actually happening here? In the financial market, the price increments are very liquid. It's literally like Amazon having, say they've got their 10,000 units here, they won't be able to go up to 110, for example, will they? Why not? Because there's going to be people offering webcams, and forgive me, it should actually be in that column, as you know, those were the legacy ones from the weekend. There's going to be people doing what? Guys, you've seen the depth of market. Aren't there offers at every price level? How on earth, if Amazon decide, oh, we're going to move the price up from 105 to 110, what's going to happen? Someone else is going to replace them. And anyway, good luck, because there's someone at 105 and 1p. Are you going to then go and buy at 110 when you could go into your depth of market, click buy at 105.01? Of course not. You're going to buy at 105.01. If Amazon decide they no longer want to offer this at 105, would you agree? You're just going to go and buy it from someone else. Can you see why in financial markets, you've got to understand this? The competition is incredible. It's incredible. It's so liquid, this marketplace, that profit opportunities for suppliers just simply do not exist in the same way they do in the real world, because there's just so many of them, right? It's so competitive, you wouldn't believe that it almost makes jumps from one price to the other redundant. It is literally, why is that? Because why do you think people are making money every time you see these guys on the high street selling TVs, doing whatever they're doing? Is because inefficiencies exist between prices. Would you agree, right? Amazon can obviously move their price up. They might have bought at 100 and sell at 105, or they can cause this price to jump, and there can almost be profit opportunities between buying and selling prices of £5, £6, £7. You've got to understand, in the financial market, it's so incredibly competitive that on the supply side, they're just suppliers everywhere. They're everywhere. You can't even turn around without there being just in your face all the time. Don't take my word for it. Look at the supply on your depth of market. It's just always there. So in terms of actually creating profit opportunities, to really hammer this home, can you imagine if Amazon are trying to make money, right? And they've got this, So let's change it up a bit. Let's say they buy it at £105, and um, that's their cost price, right? And they decide that they offer it at £110, right? Now imagine in a millisecond they turn around and someone comes in at £105 and a penny. 1p profit. That people don't understand. This is what is going on in the financial markets. They just don't get it. It's just unbelievable that people are trading something they do not understand what a beast this thing is, how efficient this thing is. Every single second, at every single price point, at the most minute increments, there's competition, right? You simply have to understand this concept that at every single price point imaginable, um, there's competition, because that arbitrage opportunity or profit opportunity is being closed. The minute you turn around, it's being closed. It's being closed, right? You've seen it yourself. Every single price point, those opportunities that you see in real life, they simply don't exist. And people just don't get this simple concept. And it's to do with this 50-50. You know, at the end of the day, price at any point, it's already at its sort of where it's at its most efficient point. Because the point is, what happens if you think about it, when you go on eBay, right? There's this disconnect between supply and demand, in the sense that suppliers will be able to buy things, and you might set up an eBay business and you see this opportunity where, I don't know, you can import something from China cheap and sell it on eBay, right? So let's say you're getting these webcams for 105 and you can sell them for 110. And basically try doing this, and what you will find is, very quickly, initially you might be one of the only people in the marketplace. Inefficiencies, right? Illiquidity, that's what it is. That liquidity doesn't exist, so profit opportunities there. So you can make your fiver on your webcam or whatever you're making. Try doing this. What you'll find is, over a period of time, say a few months, it could be a few weeks, I know I've tried this, just in my spare time for fun a few years ago. I thought, let me see what this eBay lark is all about. And it's unbelievable. I saw this small profit opportunity where I saw some, and actually, I'll be honest with you, it was Nature Valley bars. I saw them on offer somewhere in, I think it was Costco or somewhere. And I thought, oh, I can buy this and I can sell it on eBay for a certain price. And there was a little bit of opportunity in that. Guys, as soon as I started doing this, I'm not joking, within a few days, the market got flooded with Nature Valley bars. So many people started coming in, and my profit, and what happened to the selling price? It went down, as in the price I could actually achieve on it. My profit opportunity just vanished, and this took place over a few days. Obviously, it can take a few weeks. What you have to understand is this process, right? And many of you who have businesses recognize this. You're not going to be the only person in the marketplace in most goods and services out there, especially things that are more liquid, right? Things like bread and whatever it is, webcams and things. Property is a little bit different because it's quite illiquid in terms of the scale, right? The more you get towards liquid products, i.e. easily available and anyone can come into the marketplace, in terms of barriers to entry, would you agree? Competition's fierce. That profit opportunity is being closed. That gap between 100 to 105 or 105 to 110 in this webcam market being closed. My Nature Valley example, bars, these health bars, that I was able to get them for £6 a box in Costco, and I'm selling them for £10 on eBay. And I don't know, for whatever reason, market forces, people saw this, that I was undercutting them. All of a sudden, the marketplace on eBay was £15 and I was able to sell for £10 and undercut. The prices just moved to £10 so quickly, I couldn't believe it. I almost got left with stock. And to be honest, I made a loss on the whole thing. Not a loss, but I didn't come out of it with much profit or no profit or whatever. I think there was basically peanuts in it. When I considered my, obviously, time spent and transportation costs, buying this stuff and all of that, and then posting it to people, and by the end of it, I think I was lucky to break even. But here's the point. You've got to realize this process that is happening in the real world, where profit opportunities are being closed, inefficiencies in the financial market is happening in an instant. You have no idea what you're up against, and why all these people telling you, the market's cheap. The market isn't cheap. I'm sorry to burst your entire thinking and way of thinking, but you've got to understand, at no price point is the market cheap or expensive. It isn't. It's just, that's it. It is the right price. Okay? And I hope you can see this, because and just finally, to really bring this home to you, and the reason for that is this, what I was saying to you: at every single increment there are sellers. Okay? Every single increment. You have to understand that at every single increment. Can you imagine trying to compete in the webcam market when your cost is £105? There's sellers at £105 and a penny, and you think, all right, they get cleared out. Guys, as soon as they're cleared out, there's people at 2p, £105 and 2p. You'd be lucky to make 2p, and you bought it for 105 quid. 3p, 4p, 5p, every single price you look at, it's overwhelming how many suppliers there are. Okay? Can you see the challenge you're facing? If you're gonna view this market as being cheap or expensive at individual price points, you're gonna get yourself into a big muddle. And so you've got to snap out of this way of thinking. And this was really that incredible turning point for me, because I realized, wow, this is what that guy, the Market Wizards guy that I was, who never gave me 2 minutes of his time, was trying to tell me. This concept that at every single price on a depth of market, there isn't really, at an individual price point, any profit opportunity, because the market is so efficient. It's closing that opportunity that exists in the real world. Boom, that profit opportunity is being closed because there is fierce competition. Okay, so just to make sure you get the point, again, I just apologize for repeating it over and over, but it's so important, because I wish someone had literally spent a day just repeating this point over and over on a record, because it would have saved me a lot of stagnation, really, and just being average for a long period of time, until obviously I got this concept. So the final time, let's just repeat this, but with a different example. Let's say you're in the property market, and you see an opportunity, right? You buy this product, or sorry, this house for 400,000, and you offer it for 500,000. Why is that? Because you see in the marketplace that's the fair value, right? Or you perceive that to be the fair value, 500,000. So there's a depth of market, isn't there? Bids, offers, bid. You bought it at 400,000. You're offering it at 500,000. What the financial marketplace does is it's ruthless. What it will do is it creates structurally a very easy marketplace for anyone, from the comfort of their own home, institutions, whatever, to come into this property marketplace that you're participating in, and to be able to come in and put in offers at 400,000 and a penny, 400,000 and 2p, 400,000 and 3p. Guys, you're dreaming. You think you're going to be able to offer and sell this at 500,000 and make you 100 grand. You'd be lucky to make 1p. You think I'm exaggerating? Go and look at your depth of market, right? The thing is, the reasons why these pricing opportunities exist in the real market with property, where you can make 100,000, even 5,000, 10,000, a Hoover, a webcam. I'm trying to diversify with examples, so you see it's not only one item. It's because of this concept we talked about before, where supply can be dominant, prices are illiquid, inefficiency in pricing, and this final concept is time. So what it is I paused there for a second because what I've done is I've really concentrated more on the fact that obviously supply tends to be more in charge in these other markets, whereas and there's less of it and it's concentrated in a few hands, whereas financial markets, the competition, as I keep saying, at every single price level, it's insane. You just can't imagine, right? And it actually is worse. And I'm sorry, I'm gonna have to really. So if you're sitting there thinking, "Wow, it's virtually impossible for me to make money in this marketplace," the way I've been approaching it, yeah, that's good if you're thinking that because that means you've got what I'm trying to tell you. But it's worse. I'm sorry, I'm gonna make it even worse for you because what you don't understand is this concept of time. Um, because structurally the financial marketplace is so liquid, what it's allowed um, things to do is that process of where we talked about, competition coming in and closing profit opportunities where, obviously I told you of my health bars, I bought them for a um, £5 or £6, and obviously I was trying to sell them out for £10 or whatever it was, and that profit opportunity got closed very quickly. If you think about it structurally, and I'm going to show you this in terms of time, um, how do you think, or how does it actually work in a normal marketplace? So probably the best thing is if we draw how we see the chart, right? So you've got price, right? We're all in agreement, and you've got time, so the time concept. Now, what we can do is, and let me try and I'm sorry, I know this is going on for a period of time, but cannot stress to you how important you have to start understanding this is so I can really start moving you towards a different way of identifying opportunities in the market. So if we split out time into time periods, right? So time is 0, time is 1, 2, 3, right? Maybe 4, and these are days, okay? And this is the webcam market, okay? And you've got your little quantity here as well, which is measuring market orders, right? Now, obviously, that hasn't formed yet. If you think about it, that's forming as things happen. But let's think of this in terms of the webcam market, okay? So we just agreed, Amazon have decided at £105 they're going to be setting the price in the webcam market, right? So I'm really going to have to show you just how bad you've got it. And don't get me wrong, this is actually good in terms of a marketplace being liquid is obviously very good because it's efficient, but it just means the profit opportunities at individual price levels are just zero. So would you agree that Amazon on day one, as we said, they've decided, okay, we're going to set £105. Typically, bread market, obviously webcam market, typically, would you agree if you walk into Tesco's at the start of the day, if it's £1, a loaf of bread, it's not going to be jumping up and down at like a yo-yo throughout the day, is it? If you're looking at your shelf and there's bread there and it's £1, you're not going to turn around and it's £1 1p. Oh, you pick something up off the floor, £1 2p. Guys, it doesn't work like that in real life, does it? Why is that? Because of this inefficiency, right? Structural inefficiency. It's very difficult for Tesco to change their price, and they wouldn't want to because they need certainty. If they've bought for 95p a loaf of bread and they're selling it for £1, how on earth are they going to be able to predict any sort of profits or make any money if the price is jumping up and down every second? It doesn't, right? Same thing in the webcam market. If the price was every time Amazon bought, say, for £100 and They're trying to sell this thing for 105. They turn around and suddenly the price has changed. You're going to be able to conduct business, are you? So typically in the real world, would you agree? How does it work? And again, supplier dominance. Would you agree that Amazon will say, right, it's been a day, let's have a look at the data, as I explained to you in the last example, let's make it, and you saw it where I showed you that price chart. We looked at price over 4 years, right? On a day-to-day basis, it doesn't, or minute to minute, it doesn't fluctuate. It's fluctuating over time. So typically they're going to say, let's keep it the same, 105, right? Then day 2 goes past and they're going to say, let's make it 106 today based on incoming market orders that we've seen and supply factors, whatever. Then this day they might say, let's keep it 106. Again, I'm making these numbers up. Then 4th day they'll say 105, right? So the price is changing very slowly, right? Which presents profit opportunities, because if they're able to buy this at 100, they can offer it at 105, knowing that typically that profit opportunity is going to be there. Now, don't get me wrong, obviously over time it changes, but can you see this is what's also happening in, I talk about property because everyone's aware of it. If you're buying property for 400,000 and I don't know, you just need to touch it up and you realize the market value is 500,000. Would you agree if it's going to take you a month, obviously you've got financing costs and some costs, to be able to predict this, you do your forecasting, your P&L, forecast P&L, or returns that you might make on this property project. Guys, at the end of the day, you kind of know that, okay, as long as nothing major happens in the market, I can sell this in a month's time at 500,000. What you're not understanding when you're looking at the financial markets is they ain't going to let you have that benefit of time, okay, to be able to make this profit opportunity that you think that exists. It simply doesn't. The market is so efficient, I cannot tell you, it's an incredible machine because of the number of participants and supply at every single level, that what you got to understand is this opportunity that exists, right? Where I talked about, and I know I keep interchanging, but I'm doing that intentionally because I don't want to just keep it about one product. I want you to see that it's exactly the same everywhere. That opportunity that exists for Amazon to say, all right, we've bought it for 100 today. We know tomorrow we're probably going to be able to make £5. In 2 days, we might be able to make roughly the same. Property to some extent, obviously, as well. You know that as long as you get things done in a timely manner and there isn't significant shifts, you're going to be able to make 100,000, 80,000, whatever. You've got a bit of a buffer because of this element of time. Got to understand, just simply, market is so efficient. What it's doing is it's closing profit opportunities by the second, every second, right? If these are seconds, I can't even draw enough. And you don't need me. Go and look at your market dome. Does it stay static for a day? No, it doesn't. What's happening? It's going like this. Every single second of every single day, it's closing any of these inefficiencies that exist. And it's incredible how it does it. Right? That's what it's doing throughout the day. And sorry, it's very bad drawing of a chart, but you get the point. This is what a chart is, right? Go and open up your chart. What do you think it's doing? It's doing this throughout the day, right? It might go up, it might, and then it come down, and then but essentially, that is what is happening. So this process of Amazon going from £105 on day 0 to £105 on day 1 to £106 on day 2, you see this entire 4-day process. It's basically happened in the gap of 4 seconds, 2 seconds, 3 seconds. I cannot explain to you at individual price levels. This thing is a machine. It is finding buyers and sellers and matching them and closing any opportunities that exist that you think existed. So like I said in this property example, you've bought it for 400,000. Before you've even had a chance to pick up a paintbrush or even get the keys or even, speak to lawyers or whatever solicitors to exchange, this price has gone from 500,000 to 400,000 and a penny. Gone. Why? Because other suppliers are stepping in at every single price level. You just have to understand this concept of how efficient this thing is at individual price levels. So my point is, you need to change your way of thinking. You need to stop opening your chart and thinking, oh, look, price is cheap, price is expensive at this individual price level. Guys, it isn't. You have to start to understand that at every individual price on your platform, the profit opportunity is 50-50. It's at best 50-50, because any profit opportunity you think you had is being closed by the market. So what does that mean? Give up? No, it doesn't. So what it is I realized over my career, as I moved away from depth of market, is because I was so concentrated on the incremental price levels, and there were opportunities on supply. Obviously, as you saw, I was reading supply with, in terms of spoofing and all the game playing that was going on. Those opportunities themselves, because of fierce competition, algorithms coming in, see, they started disappearing as well. So not only was the market efficient, it's become even more efficient over time. As I said, structural things, because you've got platforms now. You could, in theory, buy up the entire world supply of oil futures contracts if you had enough money at the click of a button. Could you buy up the entire world supply of property at the click of a button? No, it would be a slow process. You'd have to negotiate. Can you see it's very inefficient? This creates opportunities. You couldn't buy up the whole supply of webcams, of the world supply of webcams or bread, at the click of a button, because structurally it doesn't exist. So I realized, as I obviously progressed my career, that I was gonna have to, as I started moving more towards looking away from the depth of market and trying to figure out, okay, how can I broaden my perspective and really understand markets for what they are in a sort of bird's eye view. And obviously I saw these indicators, and literally I've never even entertained the thought, because obviously I knew, having spent time in the depth of market, they're all garbage. But I did recognize this, what I've shown you on this table, and it was this. So I started to look at the advantages and disadvantages of me participating in a financial marketplace, speculative marketplace. And obviously I thought about, shall I go into business? And shall I go into the Hoover business? Shall I go into the this business, that business? It wasn't Hoover's, but I had some opportunities. And this is what got me thinking that actually the two marketplaces are the same, but what's the advantages and disadvantages, and how can I close the gap? So I realized, do you know what? Because of the abundance of supply, and supply always being there, demand is obviously much more dominant, right? As you've seen, supply is always going to be there. It's not really changing the market in a financial market in the way that it does with products and services, because there's always supply at every level. It's market orders, as I already talked about in the last section. So I thought that's a big bonus. I don't need to focus on supply, staring at supply on the depth of market the way I used to. I can drop that, and I can just look at volume profile. Obviously I've been looking at volume profile all the time because I had it in my depth of market, but I realized I could move the volume profile onto my chart, right? So that was one big thing, because volume profile is just, as you know, demand. And I thought, great, I don't need to look at supply anymore. It's kind of redundant. Don't get me wrong, I'm not saying supply doesn't matter. That's why I've put 95% here, not 100%. Look, I'm not naive. I know that obviously supply can have a very small impact, but why even bother spending my day looking at it when it's so minuscule? There's always an abundance of supply. You may not know, banks and exchanges, and they have banks have obligations to provide liquidity to the marketplace, and a lot of people who want to be members of exchanges and things, they have obligations to provide obviously liquidity, and in return they get obviously reduced costs and things, and there's a whole thing. Liquidity is always going to be there, is my point, in the way it isn't. So point is, this was a big tick in the box, but as I've already explained to you, prices were a problem, right? Because I recognize this, having watched the depth of market for so long, that, all right, in the same way you can buy a webcam at £100 and sell it for £105, or property at 400,000 and sell it for 500,000, it just simply, that opportunity doesn't exist. And that was the whole point of this whole thing, as you can see, right? And I'm sure you agree, doesn't exist because of this problem of price increments and so much supply being abundant. The competition basically at every price is insane. So I realized that this is a problem. But is there anything I can do about it? Can I say, Mr. Market, and forgive me, I'm not trying to talk to you like you're a child or anything. I'm just saying this so I can really make you understand. I hope you see it's for your benefit. Um, I'm not trying to patronize anyone. It's just my way of really trying to hammer the point home, is that you can't turn around to the market and say, oh, can you do me a favor? Can you stop transacting at such incremental levels? So obviously pound dollar would be, let's say it's at 131.50 and then 131.51. Do you mind not going to 4 decimal places? It's making it difficult for me to make money. Obviously, it's laughable, right? It's not going to happen. So it's something we just got to accept and deal with. That in the real world, where inefficiencies exist and we can make profit from £100 to jump to £105, simply doesn't exist in the market. So we just have to accept that. We've got this problem, deal with it. Stop trying to find an indicator that's going to get rid of this problem, and that's what people are doing. Stop listening to all this garbage out there that at individual price levels things are cheap and expensive. They're not. Every single price level is already maximum efficiency. Why? Because of this issue. Another problem I recognized was, typically in the real world, if you're going to set up a hairdressing shop or a personal training shop or a gym, you're typically on the offer side, right? It's easier because you're selling and someone's buying, right? Unless obviously there are wholesale markets out there, but typically 90% of the time, if you want to go out and set up your own business, a service, you're providing IT consultancy. What are you doing? You're on the offer side of the IT consultancy depth of market. Someone comes in, hits the market order. It's typically one way, right? If you're going to make it in this business, you need to do this. It's like a business plan, and recognize got a major disadvantage because it's two ways. And that's a problem, because you're no longer just on the offer side, you're dealing with people on the bid side. And can you see you've got incredible competition now on the bid side as well? Wow, it's incredible. This market is, and I'm even a little bit speechless because I haven't thought about it for so long, because obviously I haven't had to teach anyone this theory for a long time. It's just I've kind of understood this concept many years ago, and now I've just been applying it every day without even thinking about it. To me, it's like, oh yeah, but obviously now it's taking me aback a bit as well, and reminding me just how amazing this. You've got to have a lot of respect for this marketplace. And coming back to the point, sorry, I went a bit off topic there, a bit about being two-way, is what can you do about it? Can you say to the market, look, do you mind shutting down the bid column? It's too difficult for me. I just want to be how a normal marketplace is. I just want to be able to buy something, but then only offer it out. No, it's not going to work, is it? It's going to be an incredibly efficient two-way market, whether you like it or not. And why is that? Competition. Guys, you've got to understand the competition in financial markets is more fierce than in any marketplace in the entire planet. And until you start, this is why I said about having respect. can you see on social media, and it doesn't wind me up. I just sit back and laugh because I see these people got zero chance of making it. Because firstly, they ain't got a clue about the stuff I've been telling you on this slide. But more importantly than that, they don't have respect for what this marketplace actually is. And until you start respecting that at every single individual price point, the market's already priced in, then you're going to be in trouble. So we can't do anything about this two-way thing, right? Can you see what is left? Time. That's the only option left. And this is what dawned on me. It wasn't necessarily over one day, but obviously as I developed my own understanding of volume profile on a chart, it started to dawn on me, okay, right, here's something that maybe I can close the gap between what's going on in the real world and what's going on in the financial marketplace. I realized is the only hope I had, because these other things, as you can see, in terms of the market being so efficient at individual market price points, I realized there was no profit opportunity. I had to stop thinking about this cheap, expensive stuff at individual price points. And I know it's taken me a while to come to this point. And guys, this is where it all changed for me. I cannot stress this enough. You've got to move away from being obsessed about thinking of the market in terms of individual prices, and you've got to start thinking about value. Why is that? So when I say bridge the gap, what do I mean exactly? How can I get to the stage where I can be an Amazon and actually start thinking of the market the way they do, or Tesco does, or anyone does, right? Do you agree? They're able to actually do analysis or even make profits because they're able to have some concept of what value is in terms of what they're selling over a decent amount of time. So my point is, right, they're able to basically say for the day, that's the price, 105, and then obviously it changes to, I can't remember what I wrote there. I think I wrote 106, or could have been 105 again. I think it was 105. Anyway, it's irrelevant. You see the point. It's gone to 106, then it's gone to 106, then it's gone to 105. Can you see? I needed to stop. I realized I needed to it was driving me insane. I needed to stop thinking of the market the way everyone does. That, oh, it's cheap here, it's expensive at this price. And no, nonsense. I had to just stop thinking of the market in terms of these individual prices, because what you see, as I've said already, this 105 here, this 106 here, this 106, that is happening there at these individual prices, right? It's so incremental that I realized what I needed to do is I needed to figure out a way of bridging this gap between how the webcam market, the bread market, or whatever is at these prices. How can I basically encompass all of this action into sort of a value for the day? Now, the problem is that you see in the real world, obviously you can have it £105 at any moment, not in time, but almost over a day or 2 days or a month. It's very static, prices are. So it's quite easy for us to think of value as an individual price. But as you've seen in financial markets, they're closing those gaps so quickly that almost for us to equate what's happening over a day, can you see, we're not going to ever be able to really get it to a one specific price. What we're going to have to do is, so let me, just so no one gets confused, this is very clear in my head, and I want to make sure it comes out onto the screen in the right way. What we're essentially aiming to do is get as close as possible. Can you see, realistically, because the market's obviously so different and it's moving up and down like a yo-yo all day long, and actually it isn't. What it's doing, you don't realize the market at every single second, all it's doing is just closing inefficiencies, closing inefficiencies, closing inefficiencies. And the effect of that is this thing that you see on your chart zooming up and down. It's meaningless, guys. All these zigzagging that you see, it doesn't mean anything. People are trying to see opportunity in that. There isn't. You don't realize that's just the effect. You've got to realize cause and effect. The cause is the market is closing inefficiencies, as I showed you on the depth of market at all times. So we've got to move away from individual price and start thinking about how can we actually get close to value? How can we bridge this gap between what real businesses in the real world are somehow able to sort of define as value? How can we bridge this gap? So, and I know I keep repeating the point, it's because I really want you to understand what we're aiming to do. Is we're almost trying to get as close as we can on an even keel to this price. Can you see this 106 change, this 105 change? We're trying to, and I've drawn a little bit of a range because I'm saying it's as close as we can, because we're never going to be able to look. We have to accept the reality that the price does fluctuate over the day. But how can we actually close that gap and get as close to some semblance of sort of, otherwise what you're doing is you're trying to grab thin air all the time. How can we get close to some semblance of where should I be, where's value? Where is this thing? Because otherwise, all you're going to be doing with these indicators and trying to, or even thinking in terms of individual price points being cheap or expensive, is you're always going to be trying and grabbing thin air. There's too much competition, and it's already at a fair price at individual levels. But over time, what's happening is what you can do, and obviously this is using, so I'm getting to the point now. The way we do it is we use transactional data, right? What we've got is we've got market orders. It's great. We have what Amazon, Tesco's, all these guys have now using volume profile, using individual transactions. What we've now got is we've got a rough idea of approximately, right? So I need to clear some of this because it is a bit messy. I'm going to move this 105, but just remember it is 105 because it's going to make it easier for me. How can we get as close to that price that all these businesses are able to have some certainty over, is essentially by using the profile. So what this is called, it's called value basically, and it's a term that is used by market professionals that use volume profile, and essentially that's pretty much every institution in the world, right? Go and Google it. The VWAP, which I'm going to talk about in a little while, is value, volume weighted average price. It's basically value. It's a measure of value. Every single institution, bank, whatever you can think of in the world, that's how they're measuring this 105, this 106, this 106. Because otherwise, how do you do business? You can't do business if the market is moving up and down like a yo-yo, unless you have some way of grabbing it and saying, right, come here. This is where, in any given moment in time, it's not exact by any means, but it's an approximation for what businesses are doing every day, coming up with some concept of what value is, okay? So you got to understand it's no longer about these individual prices that you're seeing. And this is unique to financial marketplaces, is especially on a short horizon, right? Obviously, businesses will have to do this if they're trying to forecast for the next year, 2 years, because on that basis, as soon as you start going out further in time, you see, as I showed you on that website, prices do behave like this, don't they? They do go up and down. You saw the webcams, you saw the chocolates, Cadbury's chocolates and whatever. Over longer periods of time, even they are having to do what? Look at value. That's why in the last section, we were doing what? Saying that, there was this sort of notion of value area. But I'm saying to you, is so bad in terms of, or you could argue good for, efficiency in terms of liquidity, etc. It's a very efficient marketplace, but for profit opportunities, is so bad that it's that process that you see happening over many weeks and months in normal markets, because it's happening second by second and profit opportunities are being closed every moment on a depth of market. We have to step away and say, okay, how can we actually get to some sort of approximation of this 105, this 106, this pound that you see bread being sold for? How can we get as close to that as we can? Okay, guys, so the closest we can get to that is by using transactional data and looking and seeing approximately where did the majority of transactions take place. Okay, do you see this? Because it's not an indicator, it's real life. If I showed you this already, we talked about it in the milk example. If the majority of transactions take place between 140 and 160, and Tesco or whoever it is, these people that sell milk, they're trying to figure out where's the fair price of milk. Guys, am I going to look at a Fibonacci and say, nah, let me look at the 50%? Nonsense. It's going to be where the transactions took place, right? The answer's in front of you, and I've said this before. When you're using all that junk, you're not understanding, you're covering all this stuff up. You've got to look at transactional data. And my job's a lot easier because it's just common sense, isn't it? Obviously, the fair price is where transactions are taking place. So we're pretty much done. But my point is, again, and I noticed this being done even by... So again, look, I'd ask that you don't necessarily put any of this on a public forum, not because it's a secret, but because I've never seen this out there. I've deduced this myself. But here's my final point, and it comes back to, did you notice how I said fair price? I've even noticed people, when they're looking at volume profile and doing all this stuff, they're obsessed. They keep falling into this trap. And I think this is why even in institutions, the success rate isn't very high. And people using institutional tools is absolutely crucial. You've got to understand, there is no fair price. Can you see that? There's no individual price for the reasons that I keep mentioning. People, as I show you when we go through the theory of identifying value, using some statistical techniques, we're going to be able to actually identify exactly where these lines should go to obviously give us an idea of where value is. People tend to get so specific about prices, and you have to understand there's no fair price. It's a range of prices. It's value, essentially. This whole area, okay, is as close as you're ever going to get to what businesses in the real world can say, is £105 or £106 or whatever this value is. You've got to understand that the market simply doesn't ever have this specific price. It kind of has a value in terms of, why is that? Well, if you think about it, on any given day, transactions are taking place at so many price levels. We say approximately the majority took place between, I don't know, say a 10 pip range, isn't it? So that's going to be your fair value. So this is what I talked about in the reality check, where I said you've got to give the market wiggle room. And people find this concept very hard to really understand, is about this wiggle room thing. And I hope you can understand why I took so long to explain this to you, because you've got to understand fair value is not one point. It's basically, this is fair value. The whole thing is fair value. Okay, and that's the wiggle room I talked about. And really, it was such a liberating feeling for me when I realized I could come into the market and actually start to see the market as a range of prices being equivalent to this £1 or whatever you see out in the marketplace. And it will present profit opportunities, because you get this gyrations obviously happening around where the bulk of transactions take place. So, with the volume profile, it does present certain profit opportunities. But we're going to talk about that, and then we're going to go on actually next to talk about balance versus imbalance. Because don't forget, obviously, I've shown you a perfect market here where over one day the market transactions are taking place what? In a nice little confined area. You know that's not the case, right? So let's just get rid of everything because we're done. In the real marketplace, right, what's actually happening, if you think about it, you've got price, and then you've got time, is unfortunately you're going to get this kind of thing happening where the market will be balanced like this. Sorry, that was completely wrong because I wanted these to be days or weeks or months or whatever. The market's going to be doing this, and then it's going to shift, and then it's going to start balancing here, and then it's going to shift, and it's going to start balancing here. So even sometimes in a day, you can have volume profiles that will look like this, and then you'll have this, and then you'll have very bad drawing. It won't always be, like how it is on a day like this, where it's very smooth volume profile and a balanced market. Can you see why I got you on the depth of market? Because you've seen this. This isn't a new concept to you. It's just what you see on your depth of market. I've just put it on a chart. Okay, market orders and the volume profile. I've just put it on a chart. So what you're essentially, can you see you've got little profiles here? You've got little balances. So what the market's doing is it's going from balance, and then it's imbalancing and balancing, and then it's imbalancing and balancing, and imbalancing, and you've got to realize this is what the market's doing all day long. It's just going from balance to imbalance in value, okay? Not an individual price. You've got to get this out of your head, that this garbage where people say, oh, the market moved from 121.50 to 121.63 or 120. It's all garbage. It doesn't mean anything, as I've shown you, at an individual price level. You've got to start moving away from thinking of price moving to another price. You've got to start thinking, because otherwise what you're doing is you're doing what you basically got no profit opportunity. As I showed you, you've got to start thinking in terms of a concept of value, because that's the only way you're going to bridge the gap with how any business in the real world works. And somehow, in a weird way, if you think about it, you're creating inefficiencies for yourself to take profit from. Okay, by thinking of individual prices, just efficient to efficient to efficient to efficient. Here what you're doing is you're trying to create inefficiencies by coming out with some sort of measure of approximation of where value is at any given time in the marketplace. As I said, and I keep sounding like a broken record, where this is. And you've got to realize that actually the market is doing this all day long. It will stay balanced, right? And then it will go and test another price. And you've seen this happen during very directional markets. And I'm kind of going into the next section, but it's kind of, I might as well just introduce it here. It won't stick around very long and it will just move. Okay, so it's imbalanced. It can't find where people want to transact. As soon as it comes to a place where people want to start transacting, okay, it starts to balance again and it's happy. So you see this on the volume profile, blah, blah, blah. So we'll talk about this in the next section. I apologize if that wasn't the best explanation, you didn't get it, but give it a go. If you don't get it, let me know. I understand it's changing the way that you've approached the markets, and if you can understand this, I can assure you, you're going to be in the company of a very few people in the world who actually get that this is what is going on in the marketplace every day. I cannot exaggerate that enough. I'm not saying that for my own ego, end of the day, I'm happy to share this knowledge. As you can see, I don't want to keep this to myself. This is wonderful. Through this course, I'm having this wonderful opportunity to really share this with other people. It's brilliant for me. I believe in, positive karma and all of that. And as I said, because of this wiggle room where the market's moving around, you're never going to get the same price as me. You're never going to destroy my edge or anything like that, because the perfect price doesn't exist. I showed you, don't exist. The market will close that perfect price opportunity, but value opportunities do exist, and I want you to see that, and that's why I'm happy to share this. But again, don't want to say this too many times, but appreciate obviously if you exercise discretion, and obviously use this for your own benefit, and you can tell friends about it and stuff, but obviously don't get it on the public forums, because I'm sure you agree, none of this, it just doesn't exist. People don't have this knowledge, and yeah, I'm happy to be able to share that. So hopefully it's been useful to you. And my point before, again, I did go a little bit off track there, is if you get stuck on anything, look, don't panic. I'm always here to help. Reach out to me, ask me, look, Envy, I didn't understand this. Do you mind if we go over it or whatever? I'm happy to do that in a group environment, or even if you need it individually, fine, we can try and find some time. But the point is, I'm happy. I love talking about markets. As you can see, I've pretty much been badgering in your ear for, I don't even know how long this has gone on for, probably at least an hour or more. Yeah, it's important I say this, not talking for the sake of it, is that I don't want you to be watching this, because a lot of you will be seeing this for the first time and trying to get your head around it and getting confused. And I want you to know, I'm very much here to help you. If you don't get it, don't panic. Maybe watch it a few times. But at some stage, I will be quite frank with you. You have to understand that this is how the marketplace works. And very, very, very few people in the world do. If you can understand it, you're going to increase your chances of success incredibly. And hopefully, looking at things like this, you're going to move away from looking at complete BS like indicators and all. They don't tell you anything, okay? They absolutely don't tell you anything. And in fact, something came into my mind, and it's quite important I show this to you. If you've got a market, let's say it goes from here to here, and people use this Fibonacci nonsense, right? Let's say the market was at 130 and 120 in pound dollar, right? And that's the Fibonacci there, and you've got 50% here. I'm going to show you how nonsense this is in terms of trying to determine places to trade, and how important transactions are. This is really going to open your mind. And 50% is 125, right? I'm going to show you how meaningless all indicator tools are. I mean, every single tool, throw it in the dustbin because of this reason alone. This assumes that the majority of transactions took place at 125. Let's say there were 10,000 transactions, market orders that took place between 120 and 130 on this given day, right? There's price, there's time, 1 day. Now, what if out of those 10,000 transactions, one transaction took place here and 9,999 transactions took place at 130? So basically that was all the transactions, and then there was no volume, basically. Why on earth would you be looking at 50%? What on earth is 50%? It's nothing. Would you agree? You want to be looking at that area. This is the problem with technical analysis, guys. They're not looking at where the price is, right? Where the value is. All transactions are taking place at 9,999. So my point is this: if you bought a good, right, or you were in the business of buying pounds, buying a Hoover, buying whatever, and you had this business plan, and you were trying to think, okay, where's the price? Where can I make money? And this was the marketplace. And you had this amazing data where you knew 99.999%, which is what that is, of the marketplace is transacting at 130. Would you in your business plan write down, let's say you were going for investment and you had investors in front of you, and you said to them, I want some investment, I got this product. They say, prove it to us that you can get this price or that price for it. And you say, well, actually, my 50% is at 125. Would you do that? Or would you actually, in your business plan, say, actually, the market is buying at 130, so that is where I should be able to sell my product. Obviously, you're going to look at where the market's buying it. It's so obvious. So why, oh, why are people using indicators and saying, oh, it's at 50%? Can you see? What if one transaction took place there or zero? It completely boggles the mind that people are doing this, right? So hopefully that makes sense. You're going to drop all that nonsense now and you're going to start looking at transactions, okay, where transactions took place. And we're going to now start to hopefully move a little bit away from theory and start to really focus more on financial markets. Right, sorry guys, just when you thought it was all over, I was actually just reviewing this section that I've just put together, and I thought, you know what, let me just take this opportunity to really go through that last example I showed you with the Fibonacci really quickly. And what it is I hate editing stuff and cutting stuff out, because I want you to see that a lot of everything is just not planned. I'm trying to give you everything that's in my mind without it being scripted, and I just don't believe in doing it that way. So and this is for your own benefit. So like I said, rather than cut that bit out, I thought, let me just give them like the exact same example with the 120, 125, 130 and the 50% Fibonacci, but let me do it in a way that is really going to bring the point home across that I'm trying to think about. So, and this will take a couple of minutes, then we're definitely done. But it's really important that you understand this. This thing about indicators versus real transactions that are taking place in the marketplace. So we've got two markets here now. Let's say this is the webcam market, right? And it's 105 and 115 and 125. This is the price, right, of webcams. And then over here, for example, we've got, I don't know, 120, 135 and 150. And it doesn't matter, don't worry about the increments. The point is that could be pound versus dollar, and this could be webcams, right? Now my point that I was trying to make before when I was reviewing it, and I thought, how can I actually show like even more intensely how by using some of these tools, how off the true path to success you are, just how far you are, is let's think of this webcam market, right? So let's say that we've got this data that tells us that over the year, for example, last year 10,000 webcams were bought, but like I said in the previous example, 9,999 were bought at 105, 0 were bought here, and maybe 1 was bought here. So obviously we already know in terms of profile that's going to be thin, and then obviously going to get a big bulge here. And then similarly here, in terms of pound dollar, there were transactions that took place, 9,999, and then 0 at 135 and 1 at 150. We're all familiar with pound versus the dollar. So again, it's going to be a similar profile. So my point is, I want to show you what I'm about to show you applies to both markets. And like again, come back to the investor scenario, and you've got these investors and you want them to invest in the business, and you've been able to source these webcams at £105, right? Or whatever the price is. But if for this example, let's say you've bought them at £105 or £104.50 or whatever it is. So, but you're trying to basically see, is there any profit in this marketplace? And you've got these investors, and obviously if you've ever gone and pitched for investment or watched Dragon's Den, Shark Tank, or whatever one of these programs that are very popular, they'll obviously say, where's the marketplace? Where are you going to be able to sell this thing at? What's your cost? So you know your cost is, approximately 104.50 or 105 or whatever. And you say to them, I can sell this thing at 115. And they say to you, why? and you say, well, because, I don't know, over a period of time, whatever that may be, the prices fluctuate between 105 and 125, and that's 50%. So I think that basically this is where the price will ultimately sort of retrace to, right? So it could be down here for now. The market's at 105, as we said, Amazon, but in the past it might have been up here at 125. So you show them this and you say, well, look, I think the market's going to retrace 50% and I'll be able to sell it at 115, right? But the entire market transacted at, the only reason it ever got to 125 because was one unit was ever sold there in this whole period of time. But actually, this whole year, 9,999 units were sold at 105. Guys, you've got to ask yourself, do you think that those investors are going to give you their money and say, oh yeah, brilliant, the 50% is at 115, so you'll be able to make £10? Or do you think they're going to say to you, hang on a minute, 99.9%, 9,999 units of the 10,000 were all sold at 105. You're living in cuckoo land. You're going to only be able to sell it at 105. That's what they're going to say to you, right? Well, you might say to me, yeah, that's obvious, Envy. Well, how come then, if you see pound dollar do this, right? Why are you using technical indicators to think that that means anything when it gets to 50%? Do you see? No transactions. Guys, you've got to understand that volume, in the same way when you're trying to run a business and you're trying to see where market orders demand is, you've got to understand that these things, moving averages, squiggly lines, trend lines, without knowing where people are willing to buy this thing, you're going to waste your entire life chasing thin air. I really hope you can see why I had to do this again. And if you don't understand this point, then that's okay. You can obviously keep rewatching this until you do. But I'd highly suggest that you stop trading for a little while until you get just how ludicrous it is to use any technical analysis when you've got transactional data in front of you. You wouldn't do it if you're pitching for investment. You wouldn't do it in any other business. And I've just spent the best part of 3 hours showing you that there's no difference between a trading business and any other business. So please stop doing it. And yeah, just had to make that point. But anyway, so I'm going to repeat it again and say, thanks for putting up with me throughout this video. I hope you found it useful. We're now going to move on to balance and imbalance, and hopefully that'll be the end of the indicator bashing, because you will get it now, just how ridiculous and random all these lines and things that you see are. Firstly, for the reasons that I've just spent, obviously told you for the last hour, that individual price points, pointless, nothing. There's no inefficiencies there. You're not going to find it. And then secondly is obviously this point that I've told you here. And the final point that I remember I didn't make during the last the whole session was that you've got to remember that there's guys out there with billions of pounds, forget millions, billions invested, trying to look for profit opportunities in incremental price points. Just forget about it. It's not a viable thing for us to do. Focus on value, doing what real businesses in the real world are doing, and let's try and bridge that gap between the fluctuations in the financial market, and let's try and bridge that gap and try and somehow find some area of kind of value where we can equate it to what we're used to seeing on the shelves at our supermarket, and obviously on Amazon. It has this kind of value to it. Let's really try and give it some tangible value by taking advantage of the fact that we can see essentially where transactions have taken place, and you can see it's just the market's just giving us the answer, market feedback. All right, so hope that was helpful. See you in the next section. Cheers.